How do you get taxed if you get equity-based compensation from your employer? Many companies these days pay their employees both salary and equity awards, and these are often termed RSUs, or restricted stock units. There are a number of other terms that are used, but generally speaking, what these awards do is they give employees the right to receive shares in the company at some future point, and the period between when that grant is made and the point at which employees can actually benefit from the value is known as the vesting period. Often people sometimes think that because they're shares, they might be a capital gains item, but that's not the case, at least not to start with. When you receive the awards at vesting, it's treated as income. And obviously from a UK perspective, at current rates, that means higher tax, generally speaking, than were it capital. The awards are then taxed on the basis that they're included as part of your income in the year in which they vest. And you will usually have that paid by your employer. The way they do that is that they will take part of your equity award, and at vest, they will sell some of the shares to cover your tax liability and effectively collect the tax through your PAYE. Sometimes there's also a system called sell all, where you can set with your employer a system where actually at the point of vest, all the shares are sold, you receive the cash value of the shares less the tax you owe. In addition to that, some employers ask you to pay their national insurance contribution, the so-called employer national insurance. That's 13.8%, and if you have to pay that, your award for tax purposes is net of that amount. So effectively, you don't have to pay tax on the money you've had to spend on your employer's national insurance contributions. And again, typically that will be controlled through payroll. Where it can become more complicated is if you spend time overseas during the vesting period. So quite often a vesting period may be, say, 3 years, and you have a 1-year assignment to a foreign country where you become tax resident in that country. If that's the case, your tax liability in the UK is slightly different because it's apportioned based on where you spent the vesting period. And in that situation, payroll may get it right, but often there are errors in how they do it based on when you move payroll. And so it's always really important to check your tax position come the end of the year and your self-assessment to make sure you're paying the tax in the UK at the right rates based on the time you've spent during the vesting period in the UK. Remember that whilst your RSUs would be taxed as income at the point that they vest, and that's where your employer will deal with your PAYE tax obligations, once you've got the shares, if you keep the shares that are left after the sell to cover taxes, those shares are then subject to capital gains tax, not income tax. And one of the things that's important to know there is that often people will have lots of vestings and they'll get lots of shares on different dates at different prices. The UK operates what's called a Section 104 system, which essentially orders how you calculate your capital gain should you come to sell those shares in the future. And generally speaking, the way it works is that you order the shares in terms of calculating the cost based on what are known as the bed and breakfasting rules. So first you take any shares that you've acquired on the same day that you sold the shares. Then you take any shares that you acquire in the 30 days following the day you sell the shares, which can seem a bit weird, but it covers the ability to manipulate your base price. Once you've taken account of those, you then look at your what's called a Section 104 holding. And what that essentially is you put all of the shares into a bucket and work out what the average price over the acquisition period is, and that's your base cost. It can sound a little bit strange, but it actually works and makes a lot of sense when you look at it. We do a lot of Section 104 calculations for our clients to make sure they're paying the right capital gains when they end up selling the shares eventually. Remember that once you've got the shares from an RSU vest, you switch from being in income tax territory into capital gains tax. And so if you sell shares later after the vest and once you've received the shares, you'll be within the UK's capital gains tax regime and outside income tax. And that's an important feature of making sure you get your tax return correct. When you come to sell shares from RSU vestings, remember that there may well be FX considerations to take into account, especially if you work for example, a US employer. And so making sure that you get the gains calculated correctly, both from a share price perspective and an FX perspective, is important. At LSR Partners, we spend a lot of time helping clients with significant equity awards get their tax position straight. So if that applies to you, do feel free to get in touch.